Welcome back, fellow entrepreneurs, to The Lion's Den. I'm your host, as always, Nicco Leone, and today's episode is the first in a three-part series in which we're going to walk through the 8 key business drivers that impact the valuation of your business. As a business owner, you want to pay special attention to these because it is in your best interest to keep your valuation as high as you can at all times, because that grants you a high level of flexibility. With a high valuation, you could sell your business and be very happy with the exit price. But you could also, if you don't want to sell, raise money to grow your business. And since you would have a high valuation, you'd be able to raise more money without diluting your equity as severely. So every business owner should always be looking to keep their valuation very high. Let's dive into the first 3 business drivers that enable that. Number 1, your financial performance. It all begins with your revenue, so top line. The logic is simple, but it's powerful. Larger companies, those with higher revenue, tend to be less owner dependent. As revenue grows, normally, so does the internal infrastructure of the company. I mean, you need better internal infrastructure in order to support that higher revenue and deliver that higher amount of products and services to your customers. So that transforms your business into a turnkey operation that's more attractive to potential acquirers. They know that if they purchase your business and remove you, it's not a huge issue. So let's look at a real life example. RX Bar, the protein bar company that we've all seen in the grocery store. Their journey took a pretty crazy turn. They were founded in 2013. Their initial revenue was around $1 million, and they raised seed capital in order to grow at that point. Their valuation for that capital raise implied a multiple of less than 2 times revenue. So $2 million valuation on their $1 million of revenue. Fast forward to 2017, 4 years later, RX Bar reported a crazy $130 million in revenue. Now, when Kellogg swooped in to acquire RX Bar for a crazy $600 million, that revenue multiple was over 4.5x. Okay, so the larger business tends to earn a higher valuation multiple. Now, financial performance isn't just about the top line, it's also heavily influenced by profitability, the bottom line. A profitable business not only showcases that you have effective cost management, but it also shows that you have operational efficiency and obviously robust cash flow, which is important. So high profit for an investor or an acquirer means there's lower risk, higher potential return on investment, which makes your business a more appealing prospect. Thus, it'll receive a higher valuation. The final piece of financial performance is quality bookkeeping. This cannot be overstated. Your revenue and your profit are obviously key, but they can't be taken seriously without accurate and transparent financial records. Nobody will believe it. And I see business owners make this mistake all the time. They think bookkeeping is a cost center and that they have to reduce the cost of bookkeeping whenever possible. But like all things in life, you get what you pay for. If you think about bookkeeping as a profit center, it's a specific activity that is going to make you more profitable in the long run by having very good bookkeeping. It might be an area you want to spend a little bit more money on to ensure that you have accurate, transparent, proper books so that when you decide to raise money or sell your business, it looks really, really good to the investor or acquirer. Reliable financials not only instill confidence in the investor or the acquirer, but it also expedites the due diligence process. And it makes your acquisition or your investment go a lot smoother and more straightforward. Number 2, the second key business driver is growth potential. I want you to picture this. Building a successful business is like running a marathon, right? You know that. And as entrepreneurs, we're often looking at the sale of our business as the final mile, right? It's the end of our marathon. But you have to remember, when it comes to an acquirer of your business, purchasing your business is mile 0. They're just starting their marathon. And their goal isn't just to acquire a profitable enterprise, it's to invest in one with significant growth potential so that whatever they buy it for today, it will be worth much more when they reach their mile 26. Your company's growth potential is the magic potion that quantifies your future capacity to expand. Buyers aren't just looking at your present success, they're investing in the promise of future returns. So a company with a ton of growth potential earns a much higher market valuation because your buyer will price in that growth potential and they'll be willing to pay a higher price. So let's take another real world example. Sweetgreen. I love Sweetgreen. I went to Georgetown in DC. That was where Sweetgreen was founded by some Georgetown students, actually. I used to eat there all the time. Fast casual salad chain. And not only did they capture the attention of health conscious consumers in that single city, but then they also started to expand nationwide. And their success is really in its growth potential. They partnered with local farmers, they streamlined their operations, they embraced a digital first customer experience. Of course, all of those things, they created a great value proposition, and they now have 200 locations. But the key is that their growth potential remains extremely high. There are a ton of untapped cities and demographics waiting to be explored. Subway, sandwiches, for example, they have 40,000 locations across 100 countries. Okay. Sweetgreen has 200 locations. So there's massive growth potential still because it could just replicate its business model in other urban centers. Cities with similar demographics, busy professionals wanting quick, healthy options. That's a really fertile ground for expansion. Another thing is their digital first approach makes it a lot easier to enter new markets with an established online customer base. And that minimizes their risks, which a lot of geographical expansion sort of incurs usually. So Sweetgreen really well positioned for growth. So how do you enhance your growth potential? It's a blend of strategies. There's constant market research to identify new avenues of growth. There's investment in innovation to enhance your products and services so that you have an increasing bundle to offer to your customers or adjacent customer segments that you've never tapped. And then, of course, there's strategic partnerships that will help to open up new channels and new customer bases. The third driver, the final one for this episode, is your customer satisfaction. It's not just a nice to have thing. It's honestly the lifeblood of your long-term business value. So we always look at customer net promoter score, your NPS score, okay? And that's really what drives customers, your understanding of customer satisfaction, your NPS score, and of course, customer reviews. But a high net promoter score correlates with strong customer satisfaction. And your reviews and your testimonials act as the social proof that you need. It's not just about happy customers. It's about unlocking a world where satisfied customers become revenue generators and cost-saving marketing channels for you. It's about turning your customers into your referral engine to bring in repurchases and referrals to you. But that only happens if they have an extremely strong experience with you. These satisfied customers, they're not just one-time buyers. They're more likely to return. They're more likely to recommend. And that creates a ripple effect that directly and indirectly influences your business valuation. Let's look at a couple examples. Fresh Cafe. It's a small coffee chain that embraced proactive customer feedback. They introduced a real-time mobile app to get that customer feedback. And then managers were able to react immediately to the feedback. And that led to a 30% increase in repeat visits and a surge in positive online reviews. Because anytime there was an issue, Fresh Cafe was very, very quick to solve it. Another example, Greenleaf. It's a small landscaping company, but they understood the value of community engagement. And so they started a program to donate a percentage of their project costs to a local cause that the customer gets to select. That initiative resulted in a 90% customer retention rate and a much higher net promoter score for them. Enhancing customer satisfaction is a bit of an art, but some easy to implement action items are to make sure that you have a constant feedback loop with your customers, to make sure that you prioritize quality over quantity, and to invest in exceptional customer service internally. So that wraps up part one of our key business driver review. Don't forget to subscribe and make sure you go ahead and watch part two next.